Thank you for everyone to join us today for a discussion of the impact to your tax from the tax bill that was passed right before July 4th, right, Frank? I remember
Yes.
it's right before the holiday.
Yeah, correct.
So
Yes.
my joke is, remember 2018, that bill was passed in right around Christmas 2017. I still remember that. You remember that? Yeah.
Sure.
So
Yeah.
that I was joking, it ruined my Christmas because I had to study it. So this one ruined my July 4th. No, I didn't, because Frank is the one who's doing the research. Thank you, Frank.
Sure, not a problem.
So everyone heard a lot about this big, beautiful bill. So today we're not gonna be able to cover everything. There is no way. It's how many pages, Frank? 800?
Yeah, roughly. Yeah, maybe more than that.
Yeah, close to 1,000 pages. There's no way we could have read all of them. But the most important thing is we want to put this webinar out in a timely manner, which is this only like about not even 2 weeks after it's passed. And it's changed many times. First, the Senate has a version, went back to, the House had a version, and then Senate has a version, and then the House has to revamp it a little bit again. So there's 3 different versions. But what we want today to focus on what's the most important things that's going to impact you. So hopefully this is helpful for you guys to come in, okay? So a little bit of a spiel of both of you. I think maybe 80% of the audience today are my clients, because we basically send it to our clients. So you all should know me, but just for the 20% that maybe friends and family, I am Justine, and I'm the CEO and the founder of the Zhou agency. And Frank is our walking tax library in the office. So
Wow, that's quite a compliment. Okay, yeah, sure.
The walking library, encyclopedia.
No.
Okay. All right. And he's our tax manager. And a little bit about Zhou agency. Our core competence is really not just in the tax filing. Sure, we do tax filing, but doing the tax filing is the foundation for us to design and also implement tax efficient strategies for all our clients, so they can pursue their passions in their life. That is why we have different arms under our umbrella. We definitely have the accounting side, right? The tax side. We also have the real estate investment side and the insurance side to help implement all those solutions that would come out for clients from a tax efficient perspective. Okay. Now let's go to the meat of the presentation, right? So Frank will be talking mostly about the changes, and I will talk mostly about the implications. We are dividing the content into 3 big blocks. So the first block, like you all knew already, a lot of the temporary changes that went into effect in 2018 became permanent. So that's the first block we're gonna cover. So a lot of you might not even know, oh, it changed, it didn't change. Yeah, because from 2018 to now is the same. But if the law didn't pass, it will go back to what was before 2018. So now we're not going to go back. So it's a double negative, right, Frank?
Yes.
It's basically the same thing, but we still want to mention that. It's very, very important. There's a little bit joke here. People say, what do we mean by permanent? What do we mean by temporary? So how about the next president come and change all this will be changed? What do you mean it's permanent? So there's a big difference. Whenever you do a tax reform, if you say it's temporary, it means it will end at a certain day. So if you don't do anything, it will go back to original. But if it's a permanent one, you have to pass a new law to change it. So it's much harder. So Mr. Trump somehow became president before his 2018 reform are going to, the temporary change will stop. So he became president again. And then now these are becoming permanent. The second section is the most important section, which is the significant changes. And the third section will be just other provisions that everyone's talked about, but may not affect, I think, my client base that much. But I want you to be up to date with the information. Okay, let's go with the first one. Frank, you can go on with your list.
Sure. Okay, let's start with the estate tax exemption. So as you guys know, that is permanently increased to 14 million in 2025 as single person, right? And it will increase 15 million to in 2026 and adjusted by the inflation rate like every year. You know, for the individual tax rates, so we still use the same tax bracket as before. It's from 10% to 37%. And for the standard deduction, you know, it's increased permanently right now to 15,750 for single person, of course, $31,500 for marriage filed jointly. For the personal exemption, it's actually permanently repealed. So for the folks who may not even notice this item in your tax return, well, guess what? We don't even need to discuss about it. We can totally ignore it, right? It's just to make the tax return easier.
But for
Yeah.
older people, I remember there was personal exemption.
Exemption, right. Exactly. So the next one is the mortgage interest deduction. So we still use the same cap in terms of the allowable mortgage principal is still $750,000 to calculate the interest deduction, okay? So for the miscellaneous item deduction, most of them is permanently disallowed right now. It's used to be called like a subject to 2% of AGI. So
yes, like a
technically it's
moving
not
expense, right? Like moving.
right.
Yeah.
So it's not a big impact at all, in my understanding. So the last one I want to mention here is QBI income deduction, which I feel this is good. So we still, you know, got those 20% permanently deduction for the business owner who have this qualified business income. As long as you meet the other certain requirements, you'll still enjoy this 20% deduction. So yeah, like we mentioned, it's kind of like a very straightforward at the beginning. I feel this is the easy part. As Justine mentioned, it meant to expire this year, but because of the bill, we're gonna have those permanently right now.
Yeah. What timing, right?
Exactly, you know.
So I think in a way, from a tax planning standpoint of view, it's good these become permanent, right? So now we know how to plan. I heard so many estate attorneys say, so what's going to happen when, when the change, when we went back to before. So now I think it's good for my book of business, people like your estate tax extension or estate tax exemption is so high, right? But I just want to put one thing there. Every state has a different limit. You still have to be careful, okay? So don't just think, oh, I have no estate tax to pay. You still have state. And so the planning will be much easier. The brackets, I don't think I have anything to say. So the personal exemption, I do want to say something because we have a lot of clients who have college age kids, right? So by claiming them, you are not really getting much credit. If your income is over 400,000, you don't even get a credit. And even if you're getting a credit, the credit is only about $500 for anyone that's over 17, right, Frank? Yeah. So maybe it's better to let the kid work a little bit and be independently filing, and they can get a standard deduction. And because standard deduction is so high, and they can also apply for the American Opportunity Credit, right? So that is like the difference is like the American Opportunity Credit is up to 2,500, right? And up to 1,000 is refundable. So if you have college age kids, making sure look into your tax, it's a couple $1,000 difference, right? And sometimes even bigger. Okay.
Yeah.
And mortgage interest, there's not much to say. The QBI, though, I want to say this is great. I mean, all small business. I mean, we have a lot of small business clients. So rest assured, you will always get your 20% QBI deduction. And there's a small change there. I asked Frank to talk about it, but Frank said so it is so like, is it a nuisance? Like it's just little things. So basically it's good for you. They made a small change to make the phase out a little slower, right, Frank?
Yes.
So if your income is
range.
high, you used to get phased out easily. Now you get phased out. So it's good for you. So we definitely, you should revisit your QBI deduction with your, tax preparer. It's good for you, right? And I think this is just a great thing for small business. 20% of your net income is not taxable. Okay. I think that's it, right?
Sure. Yeah.
Yeah, a lot of people talk about the 37%. If we didn't do this, it's going to back to 39%, right?
39.6, I guess.
Yeah, 39.5. So it's 2.5. For people who make $1 million, that's quite a bit of money, right?
Of course.
So my joke is if you're under 30, you didn't even know how it was back in 2017. But at least you know that this is going to be moving forward. Okay, that's the first section, the very easy whatever was previously temporary under the TCJA now become permanent. Okay, the next one is the interesting one.
Okay, yeah, let's move to the significant part. So
Mm-hmm.
I'm so excited about this part because really you have plenty of work can do to save tax in the future. Yeah, so let's starting with the bonus depreciation. As we mentioned so many times, when the 100% bonus depreciation will be back, now it officially come back, right? So the 100% bonus depreciation is for the assets with a useful life. Sometimes ours refer to like a recovery period. It's equal to 20 years or less. So some good example will be like an equipment machine, like furniture or appliance, and also some qualified improvement. So you can basically take a 100% bonus depreciation, meaning you don't have to do any depreciation in the future, but you expense all of them immediately. However, yeah, I'm gonna say a lot of however today, I guess. So the effective date, right? You have to be careful about the effective date. The asset must be acquired after January 19, 2025. So the timing is kind of critical here.
Yeah.
Yeah.
So let me give you an example, right, Frank? Let's have a discussion. So if I purchased a rental real estate in 2024 and I fixed it up, and in 2025, after January the 19th, I put it in service, means I rent it out in February 1st, right? Let's say, can I take the 100% bonus depreciation?
Like, unfortunately, no, you still use the old schedule. I think 2025 is 40%.
40%, yeah.
Yeah.
We're still, so the 2017 reform, right, it's gonna phase out by 2026, which so you can take 40% in 25 and 20% in 26. So if you
Correct.
purchase your asset before that, I don't know how they come up with January 19. Do you know, Frank? Why January 19?
I personally I don't know, but there's a lot of like a similar dates in different tax code under the bill. So it must be something, you know.
Yeah, so if even if you put it in service after January 19th, it is still not, you cannot really claim the 100% depreciation. But Frank and I also discussed how they're gonna know. Because from an inside, where the sausage is made point of view, when we do tax, the only information we put in the software is it's the date it placed in service. So now I think the IRS has to come up with a way, not only knowing when the property is placed in service, also when you purchased it, right?
Right,
So,
and I even read the code. Actually, they have a definition of acquisition is you have to into a written contract or something like that. I
okay.
don't know how they place it.
So if let's say I live in a house I bought in 2020 and in 2025 I make it into an investment property, the acquisition is still now 2025, right?
No.
Yeah, that's what I think. I think so. But again, guys, so a lot of I should have done a disclaimer before. So you all know tax laws are passed by the two houses, but the actual like the enforcement is regulated by the IRS interpretation of the bill, right? So there's a law, you read it, and then IRS has an interpretation, and IRS is completely understaffed. So they have a lot of work to do before the end of the year to make all this. So there might be some changes, right? Not changes on the law, but the change on the enforcement. But from now, what our understanding is, the property has to be purchased after January 19th. And it's not just real property, guys. Not just like people think about investment property. Vehicles, right, Frank?
Yeah, basically, if you want to take the 100% bonus depreciation, all the assets must be acquired after January 19.
Yes, and also it has to be less than 20 years. And another thing is, I'm sure like a lot of my clients gonna get bombarded with all the cost set companies. I was kidding, like cost set company becoming the ambulance chaser. I mean, I love them, they do the work, but sometimes they just tell everyone to do it. So is 100% bonus depreciation good for everyone? Should you do cost segregation just now? So I always say just wait a little bit, because we will do your 2025 tax in 2026, hopefully in the beginning of 2026. And if we find out doing a cost segregation is going to help you, you should do it. And then your deadline to do the cost segregation is October the 15th of 2026. You have a lot of time. So don't jump into it right away, because if you're not a real estate professional, if you're not a short-term self-managed short-term rental owner, it may not help you. Like Frank said, you don't have more depreciation, you just accelerate your depreciation, right? So it really, really depends. But I think the significance of this law, this regulation here, I think the short-term rental market is gonna boom. Not for people renting boom, is people are buying boom, because everyone wants to use that short-term rental loophole to offset their current year income, right, Frank?
Yeah. Correct.
So yeah, maybe you can also just give a small education to the audience. What is the short-term rental loophole?
Okay, so if you want to like really do some like short-term utilize this loophole, the rental must be overall average rent date less than 7 days. And also if you can manage the rental like the average rent date less than 30 days, but you provide quite a bit of significant personal service. Those rental technically when you do the tax reporting is not follow the rental rule. It's like a passive rule, so it will become like active activity. So in that way, the loss generated from this activity can offset your active income, which is basically a W-2 and other kind of income.
I remember we did a webinar with one of my clients, and they're both doctors, and their names, I just suddenly forgot their name. And Nikki, I forgot the other name. The couple, the doctors, they do short-term rental every year. I'm sure they're doing one again right now. And another way is to claim as a real estate professional. So I don't want to be, talking too much here, but this is the thing that catch everyone's attention. And you should, if you are, we're doing tax planning right now, very, very busy. So make sure if you have not scheduled a tax planning, schedule it with us, and we can talk about the implication to you. Every time, the most important thing is what's the implication to you, right? Okay, let's go to the next one.
Sure. The next one will be opportunity zone. I actually love this concept. So for the folks may not like very familiar with how it works, I can give a little bit like explanation. So as long as you recognize some capital gain, you don't have to pay tax if you can invest all the capital gain to a qualified opportunity zone fund up to 5 years. Okay. So if you can hold the investment up to 5 years, you basically can reduce the capital gain by 10%. And the third one actually is a brand new when you compare with the old opportunity zone rule. So they actually add this new one as if the investment to a qualified rural fund. So you can reduce the capital gain by 30% if you hold for 5 years. Okay. So if you be able to hold for 10 years and then sell it within 30 years, so you have a chance to fully include the what we call like appreciate value over the original capital gain or the investment. Let's use an example. If you put, let's say, $100,000 to an opportunity zone fund, and after 10 years, it grow to 1 million. I just make up the number, okay? So then you don't need to pay tax on that $900,000 appraised value. So you still pay tax on the original $100,000 when you up to 5 years. So, this is good, but it's also meaning a long time commitment with some risk, right? So you enjoy to get in order to get the benefit from this tax code.
Yeah.
Lastly, is the timing, right? It's still very critical here.
Very important, yeah.
2027 will be the official year you can defer the capital gain. So don't do this in 2025 right now or next year.
No, if you do it in 2025, you will have to, it will only be deferred to the end of 2026.
Oh, still use the old, yeah.
Yeah,
the old one,
the older phase out rule, yeah.
Yeah.
So if you're gonna have some large tax capital gain coming, if you can hold it off to 2027 will be better. Yeah, thank you, Frank. So opportunity zone was also a huge topic from 2017 tax reform. So basically, if you have capital gain, you can invest in these funds, and you don't have to. First of all, you defer the capital gain for 5 years now. Before it was not 5 years, it's all the way until 2026. So depending when you do it, if you do it 2020, it's 6 years. If you did it in 2018, then it's 8 years, right?
Yes.
So now it's just a little bit different. It's 5 years you can defer, yeah. And then they also come up with this rural opportunities. So that area is not just need economic incentive. They're also in the rural area. So you get a more, you basically eliminate some of your capital gain from your original not from this property. This new property in the opportunity zone, if you hold it for 10 years, you'll never have to pay tax, right? On capital gain. Yeah.
On the capital gain, yeah.
Yeah. But again, I always say this still should be a sound investment. You never should go to get a tax loss and get a real loss. That is my oldest joke, right? So it has to be sound investment and help you with the tax. So make sure that, remember the dates, it's January 20. This is a very, very powerful tool. And I've seen my clients using them a lot to help them. Sure, we talk about 1031 exchange, but sometimes it may not be 1031 exchange, because how about if you sold stocks, right, Frank? Cannot do 1031 exchange for stocks.
Right. I
So you
also
have a
think,
huge capital gain.
I was also thinking, I don't know if this can be combined with the bonus depreciation, if you can manage that operating zone property, possibly, right? If you can defer the capital gain and also enjoy some, bonus depreciation for the rental property in the operating zone, is possible, but we'll see. We'll see.
Yeah, because most people who invested in opportunity zone, either a property or funds, they are all in real estate. Right. So the whole point is you are making that area better. You are making, you basically grow the economy in that area that needs economic incentive, right? We actually had one client purchased, we set up their own funds, and they invested in the funds themselves and invested in Brownsville in Chicago, some beautiful condos, which has very high investment cash flow. Remember that one? Yeah.
Of course, yeah.
Yeah, he actually bought 3 condos. At the end, bought the whole building. We reconverted back to an apartment building instead of So I mean, opportunity zone does not mean that they are all really bad areas that, you still have to do your underwriting. Yeah. Do your underwriting, give you so much tax incentive. This is really something you should look into now because it's prominent. Okay.
Okay, so next one is about the IT method deduction. I'm sure, I mean, this one should have mentioned so many times online or other source. People are saying, the cap, the SALT cap, which is state and local tax, is increased from 10,000 to 40,000 in 2025, which is good, right? If you think about your tax bracket, the additional $30,000 will give you probably like a 10,000 refund, right? However, there's a income limitation. Okay, so it is starting phase out at AGI $500,000, and I have checked the rule that it will be fully disappear after your income reaches to $600,000. So for the people who make 1 million, you probably cannot enjoy the benefit anyway. So, but indeed, a lot of my clients will enjoy this tax benefit for sure. Yeah, it's great.
Give you an example here, right? If someone, let's say a single person who's making 400,000, their bracket is almost at 35, right?
Yeah.
Yeah. So before they're, if let's say they're from Chicago, let's say 400,000, how much state tax they already pay? 20,000, right?
20,000.
Let's say they pay another $20,000 in property tax. So they have 40,000 in state tax paid. But in the old form, let's say 2024 tax return, he can only deduct 10,000. Now he can deduct the whole 40,000, right?
Exactly.
Yeah, which means he's gonna get $30,000 extra itemized deduction. If you translate that to tax dollar, 35%. That's $10,000, guys. Yeah, $10,000 more refund for this single guy.
Right. So
it's significant.
It's significant change. So why I think this is like a temporary, so it will revert back to 10,000 in 2030. So
I don't know why who puts that there. It's probably a bargaining chip there. It's supposed to be permanent, right?
But so that's why I guess if possible, try to manage your income and see this opportunity to save some tax during this, I think 5 years or 6 years.
And I think because of that, it makes more sense to buy a home again.
Of course.
Before property tax is basically not deductible on your federal, right?
Generally speaking, yes, that's correct.
And I really think this is probably in all the changes best for middle class.
Yeah, I agree. So the second one is for a charitable deduction floor. I feel this is like a very funny one, but it's basically saying there's a AGI floor to control your allowable charitable deduction. So if you say your income is $100,000, calculated by time 0.5% is 500. So if you have donation, it must be over 500 in order to take the deduction. So this is just like a limitation on the charitable deduction. A very small impact though, I think. The last one actually is very tricky.
I want to, the second one, I want to just say a little bit. Everyone
sure.
understand, they always ask me, is my medical expense deductible, right? Everyone asks me that. I said, yes and no, because there is a floor. The floor is 7.5%. So you have to spend more than 7.5% of your AGI to be counted. So now they come up with this on the charitable too. So you either do a lot of charitable or don't do it. I'm just kidding. You should still do it, right? This for your for the community. But I'm saying for tax purposes, if you only do, let's say your income is 500,000 and you do 2,500, you're not going to get to deduct it now. Okay.
Right, exactly. Yeah. So the next one is high income deduction limitation. I mean, this is also a weird one because I read the original code, but it's translated equal to I think it's a 35% limitation for the people who reach to highest tax bracket. Like use a very simple example. If you reach to 37, just imagine you put $1 as the ultimate deduction, you probably will save 37 cents. But now they cap this on only 35 cents for the people who reach the highest tax bracket, and kind of limit the eligible deduction for a little bit.
Yeah. So the last one is for people who is at the highest tax bracket. So even if you have your itemized deduction, you can only deduct 35% of your tax instead of 37. I have no idea why this is there. It's like a little thing, but we have a lot of clients are at the highest bracket. So you just need to know for planning purposes, right? And I think this is also going to give IRS a lot of trouble for them to change the forms, the calculations. They just have a lot to do.
Yeah.
Yeah, so this one, I think the biggest is the salt cap increase. So just know.
Okay. So the next part is the green energy credit. I think there are a lot of green energy credit that has been removed. But we just pick two most of the common one that align with our client profile. So basically the first one is the electronic vehicle credit, 7,500, right? So it will eliminate after September 30th, 2025. I think it's 2.5 months. So if you want to get this credit,
if you
you
get an
hurry
email,
up.
get it before. Yeah, I think the Tesla is sending everyone email every day right now. So
okay, I didn't know that, but okay. So the next one is the residential energy efficient property credit. It typically is for solar panel, right? So if it used to be claimed the credit by using the 30% of the instrument cost, but it's also ending in December 31st, 2025. So I mean, I don't have any comments on this part.
So basically, it's the 2022 Biden's tax reform, the clean energy tax reform. We're trying to reverse all of them right now, but I mean, we're not political, so I'm not saying anything. But and also, we don't need to list a lot of things. But these are the two Frank said will kind of affect our people. So the implication is, if you're going to do this, look at the deadline. Buy the car before September 30th. Do the solar panel before December 31st, right?
Yeah.
Because otherwise, it's not going to be here.
Right. I was joking. This is probably the biggest reason why Elon Musk was fighting with Trump so badly recently, right?
I just said we're not political.
Yeah.
Okay.
Yeah. Sure. Yeah. Let's move to the next. I think this last one under the significant change. So it's R&D expense. So this is for business owner basically. So for the R&D expense, you used to have to do the amortization through 5 years. Now, for the domestic R&D expense, it can be 100% expense immediately. So basically, it's similar like the theory, like the bonus depreciation. You can expense immediately, but it's only for domestic R&D. The foreign R&D will not work under this code. And for the small business whose income, the gross receipts less than 31 million, can actually retroactively claim those R&D expense back in 2022, 2024. Okay, so for the larger company whose income may not meet the requirements, can still have the option to accelerate the remaining R&D portion over 1 or 2 year period. The kind of accelerate the cost or expense. So just want to add something.
Yeah, so this one I feel like we don't have any large business as our clients. So the small business, if you had them, if we did a tax for you as an amortization, we can go back and amend the tax return and get you more refund. And then just let's spend money on I&D, right? That's the whole point. So
Yeah.
it's almost the same reason they give you the 100% bonus depreciation on the asset. So all these tax codes are encouraging you to invest in the economy, in the real estate. So you get a tax write-off. That's just it's a nice way to boost the economy.
Yeah.
Yeah.
Okay, I guess this is all everything we want to mention under the significant change. The rest of is the item that we put under the additional provisions, which is build some awareness because there are so many limitations as the income or industry. So we just want to list all of them. Just you want to add something, or I starting to list all of them?
Yeah, go ahead. We're definitely gonna miss some, but I think we picked all the important ones.
Yeah, I think so. So let's start with the tip income deduction. So there's a lot of item actually it's brand new. I mean, it's good to have those deduction to save some tax. If you have tip income, it's up to $25,000 a year. But the income phased out starting $150,000 for single, $300,000 for married file jointly. So if you have to check your income threshold, right? So the next one is the overtime pay deduction. So you're allowed to deduct for single person is 12,500 and 25,000 for marriage filed jointly. It's also the same income threshold. It's also $150,000 for
I want
single.
to say
Yeah.
something here. So this is, I think most of our clients are not in that two groups of people, but if you are there, it's very clear, right? But if you
Yeah.
are small business owners that have, let's say, restaurant owners, right? Or you have tip income and overtime, this is good news for you, right? So you can still deduct it as tip, paid to your employee, but they don't have to report it as taxable income. And my hairdresser yesterday asked me, so I don't have to report it. So I believe, Frank, if I'm right, you still have to report it and then exclude it, right? Because if you don't report it, how do they know how much you receive? You receive 45,000, you just don't report it, right? You report 45,000 and then minus the 25,000 will be not taxable, right?
Right. I mean, I actually read something. I think it's really helpful because I think IRS will change the W-2 or 1099 a little bit to reflect the impact because it's really hard to manage if you don't have any records. So I believe eventually we should be able to follow the tax form, put in the tax return to enjoy those deduction.
Yes, good. Yeah. And also, there will be people abusing the overtime thing. We do that, right? But I mean, they have very, very strict industry restrictions. So just again, this is the murky area. We don't want to give any advice yet. We want to see how the IRS is going to enforce this. Mm-hmm.
Right. Okay, so the next one I would call is the senior deduction. You got additional a deduction. It's like a separate deduction. With the standard or item deduction. So you get another deduction for 6,000 per person, if your age or over 65. Okay, but the phased out income still very low. It's starting from 75,000 for single, 150,000 for married file jointly.
Yes.
Yeah. So next one.
I mean, for people who's over 65, they got a higher standard deduction anyways. So this 6,000 is over your higher standard deduction.
Yes.
So for a couple over 65, I think it's almost gonna go to 40 grand, right?
Yeah, I think almost.
Because a couple is like normally right now standard is 32, and when it's higher, and then with the 6,000, almost $40,000 of your income is not taxable. So maybe we really have to. What we need to plan for my people is to really get to that taxable income level when you're 65. How to get there? Not by cheating, but by doing strategies that your income are not taxable, right?
Right. Yeah. Sure. Yeah. So the next one is pretty much very straightforward. Increase 200 for the child tax credit from 2,000 to 2,200. Good to have, right?
Yeah.
So the other one is the dependent care, which we call flexibility spending account for the people who have those kind of expense. The employer will offer this account. You make a tax-free contribution to that account. It's increased from 5,000 to 7,500, which is also very good.
Yeah, for higher income people, that 2,500 can can really translate to almost what, 1250 on tax, right?
Yeah.
Yeah, it's pretty big. And I've told everyone, if your income is higher, don't try to get the child dependent care credit, you should do the FSA. And I
Yeah.
think we've been preaching that. Yeah, so this is good.
Yeah. And the next one is above line charitable deduction, but this is only for the people who cannot take ultimate deduction, but take a standard deduction. I can remember that this one is actually during COVID we have those above line deduction for
Yeah. That was
charitable, right? Very
300 per
small amount.
person, right?
Yeah. Now they change it to 1,000. So it's still for the people who doing the charitable donation, right? If you don't have enough ultimate deduction, they still encourage you to do something and save your tax. It's a little bit like a tax benefit, right? It's roughly 300 maybe per person, right?
Yeah, so there's a little bit of conflicting here, guys, right? So we just talk about if you itemize, there's a floor for your charitable donation. So if you itemize and you're making, let's say, 200,000, right? And if you itemize, if you only donated 1,000, it's not gonna count. But if you do standard deduction, that 1,000 that will actually count, right? So
Yes.
I'm not understanding the logic behind it, but this is what it is. I'm just letting you guys know, okay?
Yeah. So the next one is the Trump account. I have read a lot of discussion on this one. It's not I don't have any judgment as to whether it's good or not, but just for your information, you should know if you have a qualified newborn baby and you open this account, the government will give you 1,000 free money. So let's just get it, the free money, right?
Okay,
And
Frank,
then,
gonna have a baby this year?
I mean, let's not talk about this right now. Okay.
So is there a time? Is it from this year or what? That one
I think as long as you have qualified a newborn baby after 2025, whenever you open the account, the government will give you 1,000 free money.
Okay.
Yeah.
I have a client just had a baby last week, so they're gonna get that 1,000 and no income limit, right?
No.
Okay. Yes.
So you can do the contribution up to 5,000 a year, although it's not tax deductible. But however, the employer actually, if they can offer this benefit, I feel it's a good offer. So the employer can make the contribution for you up to 2,500. It will not count your income. So better to check with the employer to see if
Yeah,
they
so
can offer
Frank,
this.
if you do have a baby this year, I'm gonna contribute that for you. How about that? That's a promise.
Oh, really? Really? Let me
You're gonna
check
have
with
a
my
baby
wife.
this year.
Yeah. Okay, so this is what you need to
I know
know right
Jacob
now.
is listening too, so.
Okay.
Okay, I have a
Sure.
question here. So the $1,000, I just want to clarify, Frank.
Yeah.
So the $1,000 seed contribution, the government give you money is when you have a baby, right?
Yeah.
So let's say I already have babies, so my kids are old, but I'm saying I have a 5-year-old and 6-year-old. So I can still do the account, right? I don't have to have a new baby to do the account. It's just the government not gonna give me the $1,000, right?
Correct. Yeah.
Yeah, so I just want to clarify that. So and also my employer can give me 2,500, right? So this is a beautiful thing for small business owners, like help the Franks in the world to have baby, and they encourage you to have baby.
Yeah. Yeah, of course. Yeah.
And
So
another thing. So the contribution going in there is after tax dollar, except the employer money, it will grow tax free, right?
yeah. So actually, this is like the tricky part. So the principle is after tax. It's also like you can grow free without paying tax. But when they do the distribution, I think I have seen on a lot of our article is the distribution will be taxable because it's not like a Roth account. I think the nature of this account. So the distribution will be taxable at a long-term capital gain rate.
Okay, but it's only on
again,
the earnings.
Yeah, but let's just don't make this like a finalized. I read this
I
a
know.
lot.
The ISU have ruling. So before you go open an account, let's stay tuned.
Yeah.
Okay. Because to me, if you still have to pay tax, doesn't make much sense, right? 529 would be better than this.
Right, exactly. That's why there are so many discussions on whether this account is worth it or not. But still, if you can open that, get 1,000, I feel why not, right? But if you want to make a contribution, you have so many options, right?
Yes. Okay.
Yeah. So the other one is auto loan interest deduction. This is a brand new deduction. So it's also separate deduction, separate from the standard deduction or ultimate deduction. There are up to 10,000 per year, but the income phase out starting from $100,000 for single and $200,000 for marriage filed jointly. So this is a nice deduction if you meet the income requirements.
So let's say I go and buy a Tesla today, okay? And I paid $100,000 for that Tesla. I will still get that 7,500 if my income is lower, right? Like, if I meet the income requirement. And then if I borrow the money, the $100,000, I borrowed all of it, and I'm paying 10% interest rate. I'm just making the thing up. So every year I'm paying, at least the first year I'm paying $10,000 in interest, right? So the whole $10,000 will be deducted on my tax return if I meet the income requirement, right?
Yes, correct.
That's pretty significant. That's another thing that encourage you to buy a car, and it's never had that before. Yeah. So it's
I think
up to $10,000 in interest, not in the principal, right? It's
interest, yes.
Okay.
Yeah.
And it's also of course above the line deduction, right?
Yeah.
Yeah, before you reach AGI. Okay.
Yeah. So the next one will be AMT, alternative minimum tax. I feel this concept is kind of complex, so I will just use the easier way to explain what happened. So the exemption actually permanently increased, meaning there will be less people will trigger AMT. So it's harder to trigger AMT because the exemption is increased. However, if you trigger AMT, the phase out it's become like more fast because it's revert to 2018 level, and they even increased the phase out rate to 50%. You don't need to worry about the calculation, but just to know if you triggered AMT, it's more easier to lose the exemption. So that's the whole change under the AMT.
Yeah, looks like this is also a negotiation, like somewhere in the middle, right? So we get it like from a temporary one to a permanent one, but then we add something in there to make it worse. So better and worse. So basically the concept of AMT is alternative minimum tax is you do so many tax strategy. Now you end up not paying tax. We're going to say, we're going to scratch all that. And then say, hey, this is actually your income. So you're going to pay, is it 28%? I think, right? 26 or 28, but with the higher exemption amount is mostly 28%, right? So so that's why. So we'll compare your regular tax and your alternative minimum tax. We'll pick the higher one. So what Frank says is used to be, I remember used to be the AMT trigger income level is very, very low, was around 400,000. Now it's 1 million, I think, right?
Yeah.
Yeah. So we don't want to go into I still remember when I took my CPA exam, I tripped on AMT. That's the most
it's a hard one.
It's a very complicated concept. Yeah. Okay.
Yeah. Okay, the last one, I actually also feel this one is kind of crazy. I think I will put it here. It's not because the impact is small. It's just it's for special industry. It's not applicable to all the taxpayer. So it's also similar like the 100% bonus depreciation for the qualified production property, which means it's a non-residential and doing the manufacturing and production. So this is very like a narrow industry. So you have to do manufacturing, like build a factory or plant, right? So as long as you start the construction between January 19, 2025 and to January 1st, 2029, as long as started to do the construction and finish it and place in service after 2029, but before 2039, January 1st, you can do the 100% depreciation except the land value. So now, just imagine you included the building, everything together. So if you are a business own some like those kind of similar activity or fall into this category as a manufacturing, this could be very huge impact on your tax return. But again, it's not applicable to everyone.
Yeah, this is a clearly incentive for America to bring back the manufacturing industry.
Yeah.
This is cool. Yeah,
sure.
But I think maybe 0-1. Maybe we have one client doing manufacturing. Most of our clients are professional services, right?
Yeah. Well, I mean, at least we should let a client know, right? If they have this.
Oh yeah. That's cool.
Yeah.
That's cool.
Thank
you,
Frank. Sure.
I think we're good on time. We've
I think it's
sections,
perfect.
right? The first one is temporary to permanent. The second section is really where I think the changes that's going to significantly impact my book of business, my clients. And then the last 10 is just everyone talk about, you just need to know, and may not impact you, right?
Right.
That's it.
Yeah, that's pretty much everything.
Yeah. So we pretty much gonna go to Q&A. And here is for the 20% people that are friends and family. And if you're my clients, you have my contact info or Frank's, right?
Yeah.
But otherwise, you can, if you're a new person, you don't know how to get in contact with us, you can use this link. Yeah. So this is high season for tax planning, guys. 2025 of all years, you really need to plan. Maybe not just planning for 2025, also planning for 2026 and beyond. And not just because of the tax law change. I believe, I always say this, how to save your tax today, it's only 10% of the game. 90% of the game is how to save your tax for the rest of your life. How you be tax efficient so you get more dollar to your pocket instead of working more hours. Okay, let's see. Let's look at the Q&A. We don't have a lot of questions. I only can see 5. Let's go to them. So I'm going to answer live. Mr. Lee, how are you? So Mr. Lee says, with this law, no need to form LLC from tax perspective. So my answer is this law change has nothing to do whether you should form an LLC. People form LLC for liability protection, mainly. There's also some tax savings, but this law has not changed anything in that regard. Agreed, Frank?
Yes. Yeah, totally agree. And also, form the LLC is not just, I feel, is for tax saving purpose. It's also give you some assurance and risk management about the liability size.
Yes. Yeah. Okay. The next one I think is from Miss Pham. Property tax is deductible. Yes. So this because of the SALT cap raise. Used to be property tax really for most clients are not deductible on their Schedule A itemized deduction because there's a cap of 10,000 of all your local and state tax paid. But now they raised the cap to 40,000. So if your income within the range, which is what, $500,000 for, didn't even say married filing jointly or single, just 500,000, right?
Yeah, that is the whether it's a joint, if you file jointly $500,000, but if you file separately, it's 250.
Oh,
but if you are single, it's still $500,000. Yeah.
Oh, then we should not get married.
That's the why I'm joking with you. Maybe I don't know.
Oh, maybe go get a divorce, Frank. No, don't do that. Go have a baby. Okay.
Yeah,
okay.
yeah.
So yes. The next one, Jay, okay, can you please give the specific language about this charitable deduction for non-itemizers? Okay, I haven't.
I need to interrupt a little bit. I see a bunch of people posting questions under the chat area.
But then I cannot help them, Christy. I'm gonna go with the Q&A first. If we have time, I will get there.
Yeah, I mean, if you want to ask a question, please post it in the Q&A area because we can. I mean, not everyone.
Jay, can you just send me in a quick email? You want the language on the law, okay? Frank will give it to you. Next one. Anonymous. Let's see. If you buy a Tesla for business use in the next 2 months, can you get the $7,500, the low interest deduction, and 100% bonus depreciation? This person is thinking, Frank.
Yeah.
So I think yes to most of it, but when you do the bonus depreciation, you have to deduct the credit from your basis, right, Frank?
Right, exactly.
If you purchased it for 60,000, you cannot do another 60,000 because you're getting a credit of 7,500, so your base will be lower, right?
Yes.
Yeah, and then also I think to qualify for the 100% bonus depreciation, the vehicle has to be over 6,000 pounds.
Right.
Yeah. So there is I'm sorry, that's why we have job security. There's always except and if when. So just always make sure to talk to your accountant. Don't just listen to ChatGPT. They're not there yet. They will get there one day.
Yeah. I want to quickly add on this one. So talk about the interest. So if you put it in the business, there's really no such limitation as the whole interest could be deductible anyway, without a law or no, right? It's a business use. There's no such limitation on the interest size.
Okay.
Yeah.
So Robert, how are you? That's probably a topic. Robert wants to know more about opportunity fund. This is probably you need to talk to us. The concept is when you have capital gain, you invested in an opportunity zone fund, which means that money will invest in a certain area in this country that needs economic incentive. So, you know, the governors will draw the map, and the map will be revised every couple of years, right, Frank?
Yes.
Yeah. So, and then you defer your capital gain, and then also the investment you made in the opportunity zone will not be taxed on future tax capital gain. So if you have more questions, you can certainly schedule a consultation with me, Robert. Next one is not that relevant. So let me see. That's a good one. This anonymous attendee is really thinking. He said, with additional 30K on SALT, does that mean I can convert 30K more to Roth without additional tax? Kind of right. Right, Frank?
Yeah.
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 Yes, yes, sir. Go do it. Okay. Capital gains with deferral, is it for investment made in 2027 or later? 2027. If you're talking about opportunity zone, it's starting from January 1st, 2027, right, Frank?
Right, and then I mean, every year technically you can do the same thing as long as you need to recognize capital gain after 2027, because that is the initial year this new opportunity zone rule will be put in practice.
Yeah, you can still do it today, but it's only deferred for 1 year.
Yeah.
Because that's the older 2017 reform. It's only deferred until the end of 2026.
Yes.
And the parameter, if you have questions, come talk to me, okay? Sarah is asking why we should buy a car. So the new incentive they're giving you is if it's an EV, you buy it before September 30th, you get the $7,500 if your income qualifies. And if you borrow money, you can deduct the interest payment as a deduction on your tax. That's the only two new incentives, right, Frank?
Yeah, and I feel if you have this, I don't know if for business use, always considering purchase some like assets for business use and take the 100% bonus depreciation, right? That's for business. I feel this is always the consideration to save some tax.
Yeah.
Okay. Yeah.
Brandon here says the date to buy electrical vehicle is September 30th, but she has a good question here. Does the EV credit thing also apply to hybrid vehicles, Frank?
I think this one is you have to check the IRS website to find out the eligible car. I think there also will be a very detailed category if your car is meet requirements. And also, I think right now, based on last year's filing, a lot of time when you talk with the dealer, they will give you the credit in advance. So whether it's qualified or not, you will be able to know when you contact with the dealer. I really don't, have expertise on what is the car. There's so many categories.
The answer is the date, Brenda, is September 30th. Whether the vehicle qualifies for what, check with the dealer or check with the IRS website. They actually have a very complete list. Yeah.
Yeah, under each brand, yeah.
Yeah, and the Suraj has a really, really good question. If bonus depreciation is only good for assets with life less than 20 years, can we depreciate the building or just the improvements? Very good question, Suraj. So that is why cost segregation study comes in. So a cost segregation study is going to put your whole, they will divide your whole building into different years of depreciation. Let's say you buy a property for $1 million and the building is 800,000. You cannot bonus depreciate the whole 800,000. After the cost seg, maybe in the 800,000, you have 300,000 is less than 20 year, right? The other 500,000 will take the regular depreciation, but the first 300,000, you can just take one bonus depreciation and take it out. And then also the future improvements you make on it should be 100% deductible if they are less than 20-year life. Right, Frank? Anything to add?
Yes, I mean, so I have seen a lot of like cost segregation report. I just want to give you the idea. It's like talk to them and try to get some information, because you never know, because you are not an engineer, you will not be able to know how many components in your building qualify for that category. So I have seen a lot of cases, like for example, Justine mentioned 1 million, you probably can get like $300,000 bonus depreciation. That's something you may not even know. Yeah, just check, see, you can get some information regarding your home to see how many how much of the tax will be, saved.
Okay, Mr. Lee asked whether the change effective starting 2025. Yes, right, Frank? The salt
Yeah,
one?
so correct. So, but generally speaking, there are so many different areas, and you have a different initial start year. So a lot of them is started in 2025. The salt is the one, but there are any other.
Yeah, when we don't say dates, it's normally starting from 1/1. But when we say dates, they have just weird dates like 1/19, right?
Yeah.
Sudeep has a question. Can the property taxes on rental property included under the SALT? You don't want to do that, Sudeep. Rental property tax was never capped. So the only thing was capped before was your primary residence. So you will still report all the property tax on your rental property on your rental schedule, which is the Schedule E, Sudeep. Okay, no worries. We got you. Thomas has a question. When I switch my primary residence property from personal name to LLC, does the 40K SALT still apply to me? So this is where I need to talk to you, Thomas, why you're putting your primary residence into an LLC. It's just for liability protection, then it should be okay. But if you're putting it into an LLC and rent it out, then it's not, right, Frank? I don't know why you're doing that. So if it's still your primary residence, yes, it's fine. Okay.
Yep.
Let's see. I have Adam. We have about 5 minutes left. We will help you guys. We'll do whatever we can until 1. The 100% bonus depreciation only apply to assets with useful life. Can it apply to the house? I think we talked about that, Adam, with Suraj's question, right? So only part of your building, whether it's short-term rental or long-term rental, does not matter. As long as it's a rental building, but not all of them. We have to do a cost segregation study. Next question. We purchased a 6,000 pound vehicle in 2024. Back then, it used 60% bonus depreciation. Could it deduct the rest this year due to the new 100% rule? Sorry, no. They always talk about when it was placed in service. Come on, you get to enjoy your vehicle a year, okay? Let's see. Oh, thank you, Joy. Joy just saying thank you. Oh, thank you, Joy. You're so. I think we are pretty much it. The anonymous attendee, please come and talk to us. You have too many questions. It's all yours. So yeah, Thomas, you just said you put in the LLC for protection. Yes, you can still put that on your itemized deduction. I think that would be it. So Christy, do you want me to still look at chat?
I mean, it's up to you.
Yeah, it's almost time is up. Yeah. So the whole thing is this: we're doing this not to cover it all, and not to be everything included. The more important thing is you are aware of this. We're giving you guys some highlights, and the important thing is really do planning, right? So people always says, what value do you provide? The value we provide is for you to, be tax efficient. So these are rules and codes written for you. You need to utilize it, not just to know it. Knowing it is half of the game. The other half is how to utilize it. And that is not universal, depending on everyone's situation. Thank you again for coming, and thank you, Frank. And yeah, go ahead.
People are asking about the recording. So after the webinar, everyone will receive an email from us, but that email will basically route you to our YouTube channel, and the recording of today's webinar will be posted on our YouTube channel.
Okay, and you can share with all your friends and family. Thank you.
Thank you.
Okay, bye-bye now.
Bye-bye. Thank you.